In this video, guys, we're going to look at the difference between an exchange and an index. Stay tuned. Hey traders, a very warm welcome to you, and investors, a very warm welcome to you. Okay, so we've got an index and an exchange. Now, what are the differences between the two? It's easy for newer traders to get confused, and I can see why. It doesn't make any sense sometimes. And there's an index out there that's also an exchange. There's indexes that aren't exchanges, exchanges that aren't indexes. It doesn't make a lot of sense. So let's look at the difference between the two and try and work it out. So an index, let's define an index first. An index is really a number that's made up of a basket of stocks that we call constituents that are weighted. So in other words, the individual stock movement has a different impact on the index price. That might be by my actual stock price, or it might be by the market capitalization of that company. So all of those in there, the basket says the Dow, it's 30, FTSE 100, S&P 500, you get the point, whatever the index you're looking at, they all have a bearing. Their price, their cumulative price is kind of put together in a formula, there's a divisor added and all sorts of stuff, and then you get an actual final price, which is the index, which is an easy way for people to monitor a basket of stocks. Hey, the Dow's doing this, and S&P 500 is doing that, the DAX is doing this. These are all indexes or indices. And these are the number that you get cannot be traded directly. You can't trade it because it's literally a number that's derived. But what you can trade are derivatives of the index. You can never trade the index directly, but there are plenty of derivatives. We can trade them via from UK spread bet, we can trade them via CFD, we can trade them via futures contract, we can probably trade them via an ETF. So there's different ways of getting exposure that track that, but you can't actually trade it because it's not a tangible thing. It's just purely a number that is made up of the stocks. Now you can trade the index well by buying all those stocks in the right amounts, but you can't trade the actual index. So that's that. Now we look at an exchange. Now an exchange is where a stock goes to trade, or a futures contract trades, or something trades on. In other words, it's some company that sits in the middle and says, here's a buyer, here's a seller, okay, a deal is done. So it's a central point where buyers and sellers come. I've done a video, we've really gone into deep dive about exchanges, but ultimately it's a central point where buyers and sellers come to transact. So an exchange could be London Stock Exchange, where you can trade stocks from the trade on the London Stock Exchange. The UK stock specifically, and not always, but most of the time is based in the UK because it's London, but there are companies that decide to trade on that exchange. Mostly UK stocks, there are others on there, but that's where people will come to buy and sell that specific company. Now we look at the New York Stock Exchange, there'll be companies on there that trade. Now we look at the London Stock Exchange, New York Stock Exchange. We could look at the CME, Chicago Mercantile Exchange, for futures contracts, CBOE for options. So these are all areas, venues where people will go to transact. Now it's going to depend where the stock is listed as well, or whether a futures contract different. Let's keep it simple and say stocks, where the stock is listed at IPO. So they choose to IPO, let's say Nasdaq or NYSE, and that's then where you must go to trade. Now, so obviously the exchanges want the business because it's going to bring in loads of transaction volume, and they charge an exchange fee every time you buy or you sell. Now, one thing we have got, which is a little bit of an anomaly, is Nasdaq. Now, Nasdaq stands for National Association of Securities Dealers Automated Quotations. Mouthful, who cares? It's the Nasdaq. Now, the Nasdaq in itself is an exchange. We've got companies trading on it. We've got companies like Apple, we've got Facebook. It used to be known as kind of a tech thing, but not so much anymore. There's a lot of tech on there. So it is an actual exchange. But then there's also the Nasdaq 100, which is an index, which is 100 stocks, and it creates an index. So it kind of gets confusing. Someone says the Nasdaq, do they mean the Nasdaq 100? Do they mean the Nasdaq exchange? The two are interchangeable. Nasdaq is an exchange and it's an index. The Dow isn't. The Dow is just an index. It's not an exchange. And we also get complicated stuff where we see some markets trade on exchange and then they're in multiple different indices. They're in multiple different indexes. So Apple, for example, is traded on the Nasdaq. It's also in the Nasdaq 100. It's in the Dow 30 and the S&P 500, and it's in the Russell 1000. So it's in all of these different indices, but it just trades on the Nasdaq. So it can get super complicated, guys. You've got a stock. Remember, stock trades on an exchange. The exchange is the facilitation of buyers and sellers. The index is made up of stocks, basket of stocks. There is some overlap. Some stocks that are in one index are also in the others. Now, that has no bearing on the exchange they trade in. It's just the way that the basket's constructed. So kind of complicated, I know, but it's worth kind of working out so you know what you're trading, you kind of know what you're looking at, you know what people are talking about when they're mentioning one thing or another. All right, guys, take care. See you next one. Bye-bye.